Good morning. Okay. So I'm the head of the financial institutions group at Hunton and Williams, and we've got a compliance group, and Tara and Eric with our group are here today. It's a little ironic, we're in the AT&T building, and we're talking about fintech and disruptive technology. So this topic is a topic we could spend all day on. The notion of spending 35 minutes on everything in the shifting sands of compliance is a bit overwhelming, and so we try to drill down on it a little. Obviously, compliance, you have compliance from the standpoint of the investors, you have compliance from the standpoint of the consumers, and so we'll be talking about some of the different aspects of both of those as different companies, different fintech companies are looking at different strategies. So you almost have an insurgent model where companies are looking at capital and marketing to consumers and seeking to avoid regulation. You have maybe a legion or a convergence model where institutions are looking to pair up with existing players, existing financial institutions, and that could be your rent-a-charter model, distribution like Lending Club and Prosper, using distribution with the access to insured depository institution, insured deposits that existing banks have, and obviously leverage. And then you have maybe replication, which could be direct lenders trying to do it for themselves without having a charter or having an existing partner. So you've got those three different models working, and each entity needs to consider their own compliance management systems. Traditional bank compliance management systems had 9 pillars to it. So you have board or executive oversight, you've got policies and procedures, due diligence, risk assessments, compliance officers, training, monitoring and oversight, legal agreements, and a complaint process. So those of you who are not or have never been associated with a financial institution might think of that as the Cadillac of compliance management systems, or more scary, the most expensive type of compliance management systems. So the challenge for the industry is to scale up or scale down that compliance management system 9-pillar model to fit the circumstances. And undoubtedly what we'll talk about next year is how much compliance management systems have changed. So with that, I want to have each of our panelists address some issues, and they'll introduce themselves as they do. So starting with Tony, if the strategy is for lenders to treat their loans as securities, are there still laws they need to address?
Well, the short answer is obviously yes. There are compliance laws in anything you do. If we're talking about the secondary portion where they're crowdfunding the loan via securities portion, even if we're just talking about that select portion, there are compliance issues involved based on what the originating portal is doing. For example, usury laws are still in effect, so they have to make sure that the usury laws on the underlying instrument are legal, and that what they're putting into the private placement documents are going to be correct. Say if they're saying they're offering a 20% interest rate on their borrower-dependent notes, whereas that's in violation of the underlying usury law for the actual borrower note, that would be a problem. So they have to make sure that that's at least in compliance. In terms of what the operators are doing themselves, if they're doing more than just the securities portion, such as if they're actually servicing their own loans, for example. There are state and federal laws which they may have to comply with, such as licensing laws on the state level, debt collection practices acts, et cetera. So what I'm trying to say is that it's a very subjective analysis as to what other compliance laws besides just the security laws that a portal might need to be remain in compliance with and might need to stay abreast of, depending on the types of transactions they're doing. If they're not using a funding bank or another originator, if they're actually originating their own loans, then they're going to be subject to the slew of regular lending compliance issues that other loan originators would be. If they're just doing the securities portion, they still have to be aware of the legality of the underlying loans so that they're not presenting fraudulent information in their securities documents to investors. If they're doing sort of loan servicing loans, they have to be aware of all the licensing and compliance requirements that goes along with that.
Thank you. So, Georgia, along the same lines, what methods are available for accessing investors? Do some platforms have benefits of regulatory barriers to entry that other competitors would need to scale? It's easy for the audience to determine who's Georgia in the panel.
Yes, hi, Georgia Quinn. The important thing to remember about the marketplace is that it's like a coin, and there are two sides. So there's the side that addresses all of the lending laws. That's the side of the platform that actually, originates or lends or does, whatever activity on the lending side. And then there is the side that accesses investors, and that's the side that I will talk about. I'm a securities practitioner, and the regulatory issue really stems from what type of investor you want to access. So if you're trying to access what's called an accredited investor or an institutional investor, it's a different set of regulations than what you would need to adhere to if you were trying to access a true retail investor, so an unaccredited investor. And up until this point, really very few platforms have been able to crack that code and access the true retail investor. Really, Prosper and Lending Club. Oh, sorry. It's Prosper and Lending Club via the filing of a registration statement. And then we just heard from Ground Floor earlier today in the real estate panel, and they mentioned that they had been able to successfully access the unaccredited investors. Similarly, Fundrise, by doing a registration statement on a Form 1A, a Regulation A offering, they have as well been able to access retail investors. Otherwise, you really are in the realm of a private placement. And so in those instances, you have to be very careful about how you communicate your offering. And you can really only target accredited investors or institutional investors. Accredited investors, for those of you who don't know, are investors with an income of $200,000 or more individually, or $300,000 with their spouse included. And they have to have a reasonable expectation. I'm just going to hold it. All right. With a reasonable expectation of that income continuing in the following year, or with a net worth of $1 million or more, not including their primary residence. So that's about 7% of the U.S. population. So right now, what we're seeing with these marketplace lenders and these platforms is they're really not able to access the full breadth and scope of the U.S. Potential investor base. And then just a note on the potential barriers to entry. For those of you who are familiar with Prosper and Lending Club, you know that they had to undertake a significant regulatory process to register their securities and offer them publicly. And I think that because it was such a significant expense legally and time-wise, it has created a significant barrier to entry. And now, we should all go talk to Ground Floor and see what they have to say about this, but I think it's very difficult for a new entrant to come in and be able to operate in the same space under the current regulatory regime.
Thanks. So, Greg, there's been a lot of talk in the industry about platforms and picking a regulator, ideally for the exclusion of other regulators. How has this issue played out as the industry has evolved?
Well, in honor of the recent visit by Pope Francis, I'm going to go out on a limb here and say the industry has been very Jesuitical in its approach. Basically, it has...
Easy for you to say.
Yeah, well, but no, it's assumed approval and then begs forgiveness. And so when you look at a lot of the ways that the industry has approached the regulatory environment, as Georgia pointed out, you had the problems with Prosper essentially saying, we're not subject to any regulation. We're not issuing securities, we're not a bank, we're not doing this, we're tiptoeing through the regulatory framework and avoiding all regulation. Well, we see how that turned out. there's a famous saying, you can say that what I earn is not income and therefore can't be taxed by the IRS. But when the IRS comes and takes your house and your car, whether it was income or not is kind of irrelevant. They have the control over what you're doing, and therefore you have to be cognizant of what those rules are. So if you take away anything from today's program, it's don't fall into the trap of saying you're borrowing a bank or you're running a deal through a broker-dealer, because that just doesn't work. The regulators get very offended by that, and they want to squash you when you say that. And so when you're using a bank, the bank is the originator of the loan. Make no bones about it, and then you have to work from there. If you're working with a broker-dealer, the broker-dealer net capital rules and transaction rules require them to control the transaction. If you try to compartmentalize them or push them off to the side, FINRA and the SEC are going to be all over you. Language is important, and the way you describe what you do is very important. So if you're using a bank to originate your loans, embrace it. Our bank originates the loans. They underwrite the loans. The West Virginia case, irrelevant. Madden, not really an issue. Why? Because it's the bank that's issued the loans. Okay, and you have to be very careful. It's my mantra of you have to embrace regulation. One of the speakers on an earlier panel said, everybody thinks of their firm as a tech company, but when you pull back the tech, you're really doing financial services. And what's very important to remember is if you're dealing with other people's money, somebody is going to try to regulate you. And so you're much better off deciding who you want to regulate you. So how do you do that? Well, the easiest way to do it is if you use a bank to issue your loans, you make sure the bank is A, a good bank, and B, is in compliant, and C, that they take full responsibility for the origination and underwriting process. You are providing leads, and then you're buying those loans from the bank. Okay, so you now own those loans. What do you do with them? Well, as Georgia said, you're going to sell them. Well, how are you going to sell them? Well, you're not a broker-dealer, unless you are. And if you're not a broker-dealer, you don't want to be an underwriter. So you need to figure out a way so that you're not. Well, what's that? Well, again, there are no action letters, the Angel List no action letter, and others that say if I own the loan and issue it, I have the issuer's exception. If I do a borrower payment dependent note. And so therefore, you follow the structures. Each of these structures have been decided upon after probably millions of dollars and millions of hours spent with lawyers and regulators trying to figure out how to do this. And so if you think you've figured out a way to build a new mousetrap to avoid all of the regulation, it's just not going to happen, at least not in the United States. Because, again, when you're dealing with other people's money, some regulator will figure out a way to regulate you. A few weeks ago, I was meeting with the House Small Business Committee, and they asked a group of us point blank, who do you want to regulate you? And the unanimous decision around the table was the Treasury, not the SEC, not the OCC, not any of the banking authorities, certainly not the states, because the states don't know what they're doing and tend to overreact out of the fear of investor protection, but we know where that all goes. But everyone said the Treasury, and then afterwards we said, what have we done? If we have the Treasury, does that mean we have the IRS? And the answer is no. Treasury is actually trying to do this outside of the taxing regimen, which is a very interesting development. So they're looking at this as a new business line. They want to make sure there's no potential effect on systemic risk, that it doesn't create systemic risk, which it really doesn't seem to do right now. And we also want to make sure that going forward, the regulation doesn't squash the industry, which it very well could. And so I think, you want to embrace regulation, but, make sure that you are careful in what you say, because it does come back to haunt you.
So nature abhors a vacuum, and so do the regulators.
Yeah, absolutely.
So Larry, can you, as we're doing our tour de force around compliance, can you please share the top 2 compliance issues surrounding servicing of marketplace loans and the role of backup servicers? And if you get a chance, can you talk about the role of securitization in the fintech space?
Sure. So I'll introduce myself first since we forgot to do that. I'm Larry Chiavaro, the Executive Vice President of First Associates. We work with about 80% of the marketplace lenders today, whether it's in primary servicing or backup servicing, and have been involved in most of the securitizations as well. And so, one of the main issues that you'll find today that some of the smaller platforms that are contemplating doing their own servicing is they are non-compliant. And so an unnamed platform a couple weeks ago that we're a backup servicer called me up and asked if he could pick our brain for some servicing practices. So I engaged some of our staff and we got on the phone with him. And as we started going down the list of items, we talked about text messaging to borrowers. And so I asked him, who are they using for text message services? And he said, Verizon. And I said, well, what do you mean? He said, we bought 2 cell phones and we decided that we would text message delinquent borrowers. And so as we started peeling back the onion of all of the regulations regarding FCC and opting out, and it was a mess. And so after the call, we gave him 2 weeks to fix his practices, or we would pull out as a backup servicer, because I do not want to be a backup servicer to a non-compliant primary. And we've seen this over and over and over. And so you mentioned Prosper and Lending Club, and we work with those guys as well. And Al was up here from Avant, another great company. And most of the platforms are trying to copy the model of Prosper or Lending Club or Avant. And with low volume, charging a 1% servicing fee and using a collection agency model just doesn't work for some of the small guys. And so as you start moving forward into securitizations and compliance, the rating agencies are very concerned about the model. Not so much on the Madden case with the origination charter, but more concerned about the process of moving a loan from servicing to collection agency at 15 or 30 days past due. And so on the first transaction, which was a Moody's rated transaction with BlackRock on Prosper loans back in February, we spent a lot of time with the rating agencies getting them comfortable over the process and how this works and some of the activities involved. I think you'll see that as a major issue moving forward today on securitizations. But I could be up here for an hour talking about compliance issues and FDCPA and compliant primary types of servicers, but there's a lot involved to it, and I think that the larger platforms have a handle on it, and I think the smaller platforms do not have a handle on it today.
And Madden, we've mentioned the Madden case twice, which deals with the ability to export interest rates. So, and Larry, by the way, the only non-lawyer on the panel.
Get some applause for that today from the group today.
Andrew, there's a lot of talk about lenders using social media and other non-traditional data to make credit decisions more accurately, perhaps faster and cheaper. We heard about that in the last presentation. So what compliance issues does this present?
Thanks, Peter. So just a quick introduction. I'm Andrew Smith. I'm a partner at Covington and Burling. It's a law firm in Washington, D.C. and also New York. And I've been working in the consumer financial services space for 20 years now, including a stint at the Federal Trade Commission. Georgia talked about how we're concerned about this. Folks in this audience are concerned about accessing investors and in accessing borrowers, and I'm on the accessing borrower side. I think that consumer compliance can frequently be, although we've heard about it from Larry and from Tony, both the importance of compliance with consumer laws and rules, but I think it can be a tough sell frequently for an audience of entrepreneurs and investors. But this non-traditional social media data idea, I think can illustrate a larger point about the importance of good consumer compliance. So let's say that you've decided, your analytics demonstrate to you that there is nothing more predictive than the number of friends that someone has on Facebook, and that's going to be weighted heavily in your underwriting model. And in fact, it is predictive. And it's also probably predictive the types of friends that they have. Who are they associating with? But certainly the number of friends, the number of connections, and the roots that people have in a community, any community, is predictive, not just of fraud risk, so a low fraud risk, but also of credit risk. So you've decided this is your secret sauce. Well, think for a minute about two issues. The first is fair lending. The second is whether or not you're permitted to use that data in that manner. So, fair lending. You all probably know that federal law prohibits you from discriminating against consumers on a prohibited basis. Prohibited basis could be race, national origin, age. What happens if no one over 50 uses Facebook? So at that point, and as a 50-year-old man on the panel, I can testify that I know what Facebook is, I know how it works, but I don't have a single friend on Facebook. I have a lot of friends on LinkedIn, or not friends, what do we call them there, just connection. What happens if only young people use Facebook? Now suddenly you may be found to be discriminating. This is going to have a disproportionate impact on older people. You may be found to be discriminating against older people based on the use of that algorithm. Now remember, this is your secret sauce. This is the whole franchise. This is your big insight. You've gone out, you've patented it. Now comes time where there's investor interest in the company. Maybe you want to sell the company, maybe you want to go to market with an IPO. The investors come in and take a look at this and they say, oh my God, this is a fatal flaw. This is the franchise. This is the whole value of the company. And we can't buy this. So the other issue to keep in mind is the use of that data. So frequently this is the case with data vendors. I'm not sure if it's the case with Facebook, but there's a provision in the terms and conditions that says you shall not use this data to make any eligibility determination about the consumer, to determine any consumer's eligibility for credit. Why is that in there? Because the data vendor does not want to become a consumer reporting agency like Equifax, TransUnion, and Experian. If they do, they are subject to a raft of regulations comes cascading down upon them, including backbreaking potential liability of $100 to $1,000 for every single name that they sell in violation of the law. So again, a fatal error. You cannot, when you go to market, when someone is diligencing you, they see the data that you use, and they see that you're actually prohibited by contract, by the terms and conditions with that vendor of using the data in that manner. Again, a huge compliance problem. So this is compliance, worrying about regulators, worrying about consumer class actions. This is sort of the workaday. This is what banks deal with every day. But I think that what we need to be focused on are these really fundamental compliance issues that go to the core of the business model and rooting those out before they become a much bigger problem.
Thank you. So what we've done is we've tried to give you a little taste of various aspects of compliance in the ecosystem, and we've left some time for a couple questions from the audience to any of us. Any questions? Yes, sir.
You mentioned the CFPB, and here in the mortgage industry, they're tearing it up pretty badly. How are you guys seeing your models, your clients' models?
So if you couldn't hear the question was about the CFPB tearing it up in the mortgage industry and other consumer spaces, and how would that impact various strategies. Anyone want to jump in?
Well, I'll take that. It would be devastating. I mean, the CFPB is a blunt instrument, and they. I don't think it's turned on. It would be devastating if the CFPB were to decide that they had jurisdiction over this industry. The CFPB is a blunt instrument. They tend to, when you have a hammer, everything looks like a nail. And unfortunately, that's the way they look at this. I mean, aligning the organization or viewing the organization as if it were payday lenders, for example, is the most likely route that the CFPB would use to come after this organization. So it's very, very important that you avoid the characterizations or the attributes of payday lenders. Because if they can paint you with that brush, you will get drawn in, and that will be the end of your business.
So if I might, the CFPB is where I spend all day, every day. And they, sad but true. We are all regulated by the CFPB. Larry is, for sure.
Absolutely.
So we have, but you're right, Greg, that maybe the fundamental business business model, the prosper, the person who's issuing securities, that's specifically excluded from the CFPB's jurisdiction. But if you're engaged in marketing loans to consumers, originating loans to consumers, selling analytics to help lenders underwrite loans, you're involved in the servicing of loans and the collection of loans, you're squarely subject to CFPB regulation. Right now, I think that you haven't seen a lot of notices from the CFPB, enforcement actions and the like against folks who are operating online, simply because there's not a lot of scale, and the CFPB, although it's a big agency, its resources are limited, so it spends a lot of time with Bank of America and JP Morgan Chase. And there's an element of swinging for the fences. They want to get big headlines. But we represent folks in the online lending space, not necessarily anybody in this room, not necessarily marketplace people, but there are civil investigative demands all over the place. And just last week, there were two big debt collectors, Encore and Portfolio Recovery Associates, who got hit with multi-million-dollar fines.
Correct, and we're not debt collectors. We don't buy any loans at all or buy discharged debt. So they've gone after that. But what you'll find is many of the traditional lenders are now moving over into marketplace lending. So whether it's purchase finance companies that lend on mattresses and furniture, military lending recently, the CFPB has come into space, and you'll see more of that today.
So the short answer is we're already there.
Yep.
It's really just when it registers with them and they start paying more attention to it. Other questions? No? Okay. Well, again, we thank you for your time.